The insurance market is changing, and there are 3 reasons why we see this disruption taking place. Customers are demanding the same level of service from insurance as they have become used to in other parts of their lives. Sectors are converging, enabled by technology and reducing barriers to entry. Opportunities to capture value from the value chain without taking on the risk. When applied to commercial insurance, we see a collection of connected forces reshaping the market.
The evolution of aggregators from simple comparison engines to sophisticated platforms is likely to be the largest disruptive force in the small and medium-sized enterprises insurance market. This will be particularly true for small businesses who will look for convenient, easy-to-use platforms to serve all their insurance needs. With growing functionality, expanding product coverage, and a widening customer base, the rise of aggregators may result in traditional broking being less relevant. Similarly, insurance carriers will likely be forced to compete predominantly on price and bundled solution offerings, and will need to find other ways to differentiate.
The interconnectedness of our rapidly changing world is creating new risks, and the controls over these risks are not keeping pace. It's not difficult to imagine the prospect of a 3D printed bridge collapsing, undetectable gene technology infiltrating the food chain, or self-learning robots disobeying instructions. The nature of assets that businesses are protecting has changed from steelworks, car plants, and oil rigs to brands, cultures, and intellectual property. Insurers have the opportunity to offer a range of new solutions to help clients manage these risks.
The high level of capacity has become a new norm for the reinsurance market, putting increasing pressure on insurance rates. This is no longer a cycle, but a structural change, because enhanced risk modeling techniques and new alternative capital products have increased the attractiveness of such investments. More and more business lines are being impacted as alternative capital providers shift their focus from property to more nascent risks such as liability, political risk, and cyber. In short, alternative capital is here to stay, and it will take seismic economic or regulatory changes for capital to leave the market. High levels of capacity is both a threat, such as reducing prices, as well as an opportunity, enabling insurers to cater for emerging risks through alternative capital structures.
Traditionally, the role of the insurer has been to protect, ready to write a check in the event of something bad happening. However, customers are now demanding broader solutions, such as providing much-needed support after an event, or even preventing incidents from happening in the first place. We expect that by 2020, there will be 8 billion people operating 20 billion connected devices, which means that customers will be able to look for alternatives outside insurance to manage their risks. Claims will likely go down, and customers may increasingly self-insure, putting pressure on the industry to innovate and stay relevant.
The world has changed faster than ever in recent years. Insurance players have struggled to keep pace and enhance their capabilities to stay competitive. A quick way to bridge this capability gap is through collaboration. Historically, the focus has been on building or buying capability. But with the exponential growth of insurtech startups, insurance players can find partners who can help develop and co-create better products and solutions, improve access to target customers and markets, and drive internal efficiencies.
The world produces 2.5 exabytes of data every day. That is equivalent to the storage of 150 million smartphones. This creates a lot of noise and doesn't necessarily provide useful insights. With this much information available, competitive advantage will no longer come from having more data, but from being better at making sense of it. Insurers have started to recognize this and will need to improve in 3 critical areas: collecting the right data, analyzing it in the most effective way, and then using this data to generate true competitive advantage.
Alternative business models are emerging to meet the changing needs of customers and shareholders. This is reshaping traditional industries faster than ever. Organizations are adopting new approaches to remain competitive, which is placing huge pressure on old operating models. Legacy processes, technologies, and even mindsets and behaviors require significant focus, redesign and transformation. The winners have clarity of purpose, consciously invest in detailed design, drive enterprise-wide alignment, promote rapid execution, and embed a culture of continuous improvement. Visit kpmg.com/strategy to find out more.